Welcome back, viewers, and get ready for our first round of panel discussion. The topic for this would be how regulators can help NBFCs in generating liquidity amid the pandemic. So, the COVID-19 pandemic is truly an unprecedented event. While the existing challenges are worrisome, the fear of escalation of problems with a third wave in line calls for an urgent need to build strategies to fight the liquidity concerns. And the role of the regulator is significant in this regard. So, our panelists for this discussion would be Mr. Ashok Mittal, Chief Executive Officer, PrestLoans, who would be moderating this discussion, Mr. Umesh Revankar, Vice Chairman and Managing Director, Shriram Transport Finance Company Limited, Mr. Sabyasachi Rath, Chief Executive Officer, Karvy Financial Services Limited, Mr. Shachindra Nath, Executive Chairman and Managing Director, UGRO Capital Limited, Mr. Alok Aggarwal, Chief Executive Officer, National Trust Housing Finance Limited, Mr. Sandeep Wirkhare, Managing Director and Chief Executive Officer, Indian School Finance Company, and Mr. Thiru R, Chief Operating Officer, Kinara Capital. So over to you, Mr. Ashok Mittal, for moderating the session. I think we've lost Mr. Ashok. So if I can request Mr. Sandeep to just take over for a brief moment till we get Mr. Ashok's connection back. You're on mute, sir.
Sure. Thank you, everyone, for joining this session. I welcome you all and welcome viewers also. To start, I think it's very important for all of us to deliberate what has NBFC journey been. I remember very, very long back, 94, 97, maybe 94 to 2000, NBFCs were actually looked at by regulators and most of the other stakeholders as one of the shadow banking activity or maybe only a supporting role that NBFC was playing. But it has completely changed in last, I would say, last 10 years or so. Not only regulators, but also shareholders, lenders, bankers, everyone has started looking at NBFCs as one of the important stakeholder in economic development. And to the extent that, as my memory goes correct, I think NBFC today of all banking credit, we form almost 20% of total banking credit. And if we include HFC also, it's even more, 40%. So that's the kind of strength that NBFCs and HFCs has. But also from a regulation perspective, I think we have come a long way in terms of instruments, in terms of structure. Maybe it makes sense for us to make this discussion more relevant, not only to include only instrument, but also a structure, because unless and until you have a right structure and then get into instrument and possibly within that instrument, structures of instrument. So that's how I would like to moderate this and start this session. Maybe Sachin, I would request you to give some sense on your experience has been tremendous. Some sense on starting from maybe structure or instrument and structure of the instrument.
Thanks, Sandeep. I think so. As you rightly said, that in my last 2 decades of how I've been seeing a non-bank finance company, it has always hovered around from whether this being a relevant set of institution, whether it the India needs NBFCs or not. I think so. When I look at prior to Usha committee report or prior to 2012, there was always a doubt in people's mind that what this entity is and whether, especially in the minds of regulator, whether you need NBFCs in India or not. And it's a good part actually in last 10 years or so, or 7-8 years or so, that right from the government, the policymaker, which is regulators, and generally the broader ecosystem, everyone has come to at least one common theme that NBFCs are required, and without them, the unserved market of India cannot, get the credit dissemination. So that's very good part of it. Now, second part of is that most of the NBFCs have very successfully built asset side engine, and which are very unique, and where banks have virtually struggled in reaching out to certain segment of the market. Whether these are NBFCs which are specialized in sector, whether these are NBFCs which are specialized in some kind of product, or which are NBFC which very deeply penetrate in certain portion of geographies. So that is not a challenge, but is still, unlike banks, which has a very stable form and shape of liabilities, NBFCs still don't have that. And most of the NBFCs are dependent upon one single line of financing, which is the banks. Capital market also over a period of time, just it's very volatile, because depending upon how the broader market ecosystem. So obviously there is a need of figuring out a way that if the NBFCs have to continue providing the service to the underserved market, how the liability would be taken care of. If you look at pre-IFS and post-ILFS, actually pre-ILFS, it actually looked like that the capital market would become a perpetual source of capital for NBFCs, and that's why they were growing very fast. If you look at post-ILFS, it actually has become very, very volatile. And fortunately for all participants of NBFC, actually this time, post ILFS crisis and also during pandemic, both regulator and the government actually did very concentrated effort to provide liquidity. So today, if you look at it broadly, overall system, the liquidity is very strong. Little bit of capital market is also quite open. But if you ask me, can I keep my hands on my heart and believe that the similar level of liquidity would be available for next 10 years to come? I don't know. I think so that continues to be a challenge. But I think one of the things which we should remember, Sandeep, is that regulators broadly are trying to create a non-wholesale structure of providing liquidity to NBFC. There is a very serious focus of two things: banks not to lend to NBFC, rather focus on either purchasing portfolios or doing co-lending. Now it is time would tell whether that would work or not work, but there is a general reservation about doing passive lending to NBFC from banks, but doing more active partnership with the NBFCs. And I think so that's where the future is. And for everyone in the NBFC universe, they have to keep this in mind, that it will become more off-balance sheet liability than on-balance sheet liability.
Sure. Thanks, Sachin. I think you made a very important point in terms of liability side structures and NBFC, whether this kind of liquidity would be available perpetually or not is a question, and I agree to that. And also that brings another point, relevant point is whether the structure of, our banking structure, does that need some deliberation? Because that also is related to liquidity instruments and structures of liquidity. So maybe Mr. Umesh.
I will just add, just so that everyone is reminded of, today we have majority of the source of, and I'm not talking NBFC which are in, which Umesh runs, and what we call the large corporate AAA NBFCs or AA plus NBFCs. I'm talking the universe of the other set. Remember this, that today 70% of India's banking is in the hands of 12 public sector banks. So that universe has already shrunk. In the next 12 months time, you will see that going down to 5 or 6 maximum, because either there will be divestment would be happening and more consolidation would be happening. And that's very scary, that where every NBFC has to go only to 5 public sector bank and trying to generate their liability would be a very difficult task.
Very relevant point, and that brings me to brings my question to Mr. Umesh, because he also runs a very large NBFC, and today I think there are many NBFCs who are possibly on asset side and even on liability side. They would be larger than many of the banks. Even smaller NBFCs, they would be larger than possibly small finance bank. Would you want to highlight something on this, Mr. Umesh? Is our structure right? Do you have any view on structure, or maybe you think, because ultimately it depends on structure and what kind of instruments are applicable. You are a bank, different instruments. NBFCs, systemically important, different instruments. Rating, different instruments. Any thoughts on that, Mr. Umesh? Your voice is not clear.
Okay, I was in a mute. Thank you, Sandeep. Shachindra has already highlighted on the broad structure of NBFCs, small, large. What I feel is, as Shachindra rightly put it, the banks becoming large and few in numbers. Over the period, they will not be able to retail as effectively. Maybe 20 years back, public sector banks would have been doing the retail lending more effectively in the rural area, in the maybe private sector. Their effectiveness would come down. So where NBFC would fit in is most of the NBFCs, were large or small, they have been focusing on underbanked, underserved, unbanked. That is the segment we have been trying to reach because of technology, specialization, knowledge, and maybe geographical reach what we have. Now, banks should effectively use this because we are part of a financial structure that is built over the period. And NBFCs in the last maybe 10 years have been growing more aggressively because it has been vacated by banks to some extent. So I feel even though the large private sector bank have a technology, they have a reach, and they are able to go to a small ticket effectively, but there will be many people who will still not onboarded onto a technology platform fully. And there you need to understand each of the businesses, because businesses are so diverse in India. So whether it is MSME or vehicle or housing, so diverse, and the cash flows of each of these individuals are totally different. Unless you go close to them, you don't understand. It cannot be just put it on the technology platform and addressed. So the being part of the total structure means, now imagine there is a private sector lending. Now RBI says private sector banks have a target. Now for the NBFC to flow the bank's money through a NBFC to a private sector, they put 5% cap. I think that 5% cap should not be there. It can, because banks can easily leverage on the knowledge of NBFC, and it helps banks and NBFC both. Now, co-lending has certain challenges. Co-lending, you cannot grow business, and it is as per the credit norms of the bank, because it sits on the platform of the bank. It becomes challenging to flow the money or flow the credit as easily. So the bringing NBFC into a total financial infrastructure and being a part of the system is very important. Apart from that, giving some additional refinancing option to NBFC directly by the RBI or through some instrument or intermediary or through some financial institution continuously is as important, because you cannot 100% depend only on bank, because banks also will take time to understand each of the NBFC's business and lending. So if at all we need to reach bottom of the pyramid and look at each individual NBFCs and individual customers and strengthen that part of the financial inclusion, then NBFC plays very, very important role. And I think increasingly, as you rightly put it, both RBI and the government both have been appreciating that and trying to try to bridge that gap. But still, I feel there is a long way to go. So we need to continuously work on that. I think we here who are senior in the business continuously work and highlight that, and that should help the smaller NBFCs, new NBFCs that are coming in a specialized area would be able to get credit on time, and the customers ultimately will benefit out of it.
Thank you. Thanks, Umesh. It's really helpful. I think we have also, relevant to this is the kind of instruments. The way we are taking this discussion seems to be possibly leading us to have relevant instruments that should be available to NBFCs that Sachin also has pointed out. And we have Sabyasachi Rath also, who has worked with rating agencies. Any view, Sabi? Sorry, I call him Sabi because I know him very well. So, Sabyasachi, any view on the kind of instruments that we have seen? That is question one. And secondly, maybe your views on liquidity vis-a-vis collection, because your company is more focused on collection also. So there are two parts to question. Maybe you can take whatever you choose first.
Yeah, thanks, Sandeep. I think it's very well put by Mr. Umesh and Mr. Shachindra. In fact, I think the panel is very diverse. So you have a behemoth like Shriram Transport, headed by Mr. Umesh, which is a very large NBFC with almost with an AAA rating. Then you have UGRO, which is one of the fastest growing NBFC, almost 1,000 crore. Then I will actually say that you are a small size or a mid size NBFC. So you are right, Sandeep. When the regulators are looking at the instrument, they have to look at the instrument which will actually help across the segment. And there has been discussion paper recently where they are talking about regulating the NBFC, and it is decided between a tier 1, tier 2, and then a less than 1,000 crore. I think as a NBFC, we are a systemically important NBFC. We don't mind being regulated more and more, and to get into a higher regulatory approach like a risk-based supervision. But to be very frank, Sandeep, the instruments which were there during the entire COVID time were of no help to us. So I'll actually talk about some of the instruments. So let's start with a PSL guideline. So if you see the PSL, the RBI has actually said that the onward lending is part of the PSL. You will see that RBI has been very on and off on the onward lending for PSL. And it actually said that the PSL under the onward lending, the fresh loans what you give will be for the qualify for a onward lending. So you'll actually find that's a challenge because most of the banks are not looking at that PSL categories. They believe that a small and mid-sized NBFC and for them the delinquencies, and they want to see the effect of moratorium, that the moratorium effect will pan out and how the portfolio will behave before they give you onward lending. So that's something which has not been too much of helpful to us. In fact, banks also have got a lot of avenues for PSL lending now, because government has recently said that anything related to COVID, be it a personal loan which you give to person who is gone through COVID, also is part of the PSL. So they have a lot of avenues for PSL. So that has not been successful. Now coming to TLRTO, TLTRO. So TLTRO 1 was never successful. In fact, TLTRO 1 actually, if you see, 88% of the money actually has gone to NBFCs, which is AA plus rated NBFCs.
Yeah.
Okay, so it was of no help to us. Then coming back to TLTRO 2, there again it said that 50% of your money has to go to NBFCs which are less than 500 crore. We definitely qualify. But one of the issue there was that you have to have a minimum investment grade. So I'm talking about not for us also, even lot of NBFCs or lot of fintech companies which are unrated, the banks were not ready to give them the TLTRO2. So that also, again, there are a lot of money which is not utilized. I think TLTRO2 is only utilized only up to 20 to 30%. So these are the two critical things which came in. The third is that RBI came up with a circular saying that there can be SPVs. Through SPVs, the banks can actually do subscription to the CP and NCD for 3 months. That again was minimum was investment grade. But apart from investment grade, you look at most of the NBFCs like us, we have an average asset maturity of anywhere between 7 to 10 years. So we are actually looking at a long-term funding to correct our balance sheet and to tide over the liquidity. So this 3 months, what is will be done by SPV is basically just to extend your repayment by 3 months. That's of again no use to a small and medium size NBFC like us. And when you go through SPV, it is very expensive to create a SPV. So nobody will create a SPV for 3 months money to be borrowed from the bank. So the instrument, you are very right, Sandeep, that the instruments which are there by RBI has not been broad-based and actually has not helped us or helped most of the NBFCs which are the small and mid-size. I think one of the suggestion which has been there for a long time is to create something called like a NHB does for the HFC, a refinancing window. Okay, and it has been there for a small and mid-sized NBFC. Even SIDBI also should come out with a refinancing window where they should also look at refinancing the old receivable which are unencumbered from the bank. And they should, rather than looking only as, most of these PSU banks or even all these AFIs, you'll find that they do a tick box approach. So they'll say that if you have 5 criteria, let's say you should be there into business five years, or your NPA is less than 6%, or your investment rating, they will fund you. I think that is not the approach. Yeah, if let's say somebody who is not an investment rating or somebody who is unrated, then they cannot even go to the PSU bank. They don't even entertain. So what they need to do is that they need to look at the quality of your receivable. They need to look at how old is your receivable, how has been the performance of your receivable, and they should look at giving a refinancing window. So the instrument which is very potent is giving a refinancing window. So that's something which I think is really lacking. We have represented to RBI many a times asking for help for a small and mid-sized NBFC like us, but we have not really seen anything on the ground, Sandeep.
Very relevant point Sabi has made in terms of how TLTRO has helped smaller NBFCs and mid-sized NBFCs. Though we talk about liquidity, but our experience has been liquidity has been very good at AA, AAA rated NBFCs, and liquidity was not there at all in mid-segment and smaller NBFCs and HFCs. Maybe because liquidity today it's going more towards your consumer side. So maybe Alok's view would be very relevant here from National Trust Housing Finance, because that's a segment which is today buzzing with demand. Though it is very small portion of whole economy, but small but significant. Maybe Alok, from your side, as Sabi mentioned, TLTRO did not help, or even PSL guidelines. That also is, as I understand, it is only for a time specific. So it's not, and also the way Sachin mentioned that liquidity is there today, but is that long term? Will it continue for 10 years, or also is something which is a broader question? Over to you, Alok.
Thank you, Sandeep. The views shared by my earlier co-panelists are very valid. As we rightly now understand, we are all in the same storm, but our boats and the size of the boats and the shapes of the boats are totally different. The storms are easy for the ones, as we call in our industry, the AAA, AA plus rated companies, and the small and the medium housing finance or NBFC companies who have not yet reached that threshold. For them, it's very difficult to navigate the same storm. As all the measures, which the regulators have been putting in, especially the RBI, is like one size fits all. When they declare moratorium, anybody from, say, a blue chip listed company like a Nestle or a Reliance can avail a moratorium to anybody running a small individual loan. So one size fits all approach may not work all the time, and that is also the case for liquidity position in the NBFC space today. As many of the schemes which the regulator came out with with maybe a good intent, but due to the application on the ground, it could not be successful. Housing finance industry has its own limitation because the type of instruments we need are very limited. Typically, we raise funds for a long term. Our loan tenures are on an average about 8 to 10 years. So certain instruments which are available in the market, like commercial papers, short-term borrowings, or even NCDs, which are deposits of short-term in nature, are not a viable option in the housing finance industry. For us, the basic option which we go forward is bank term loans, which are of long term. And after the ILFS crisis, and then the story of a couple of HFCs not honoring commitments, the liquidity has taken a hit in terms of the availability of credit. So the sources of long-term financing are very, very limited. But luckily, we have a regulator like NHB which supports us with refinance, and they have been very supportive in the crisis. In fact, last year the NHB came up with a special refinance where entire receivables of housing finance companies were given to them upfront for 1 year. And again, this year they have come up with the similar options. But overall, after crisis, after the wave one, people were prepared. They had built-in liquidity buffers, and the economy luckily did a V-shaped recovery. Business picked up post that, so things were going good. But then the second wave hit us before we could fully recover. And second one hit us really bad because this time the impact was not only monetary, it was personal. Many people got impacted, which did not happen in the first time. So before we could stand up, we got hit again. And the consumer sentiment in terms of our end customers, who are mostly self-employed, small-time businessmen, whom we lend to in the unorganized sector, have had to keep their shop shut. So their cash flow will take some time to revive. They have, in fact, most of them have borrowed to survive the lockdown period. So the entire cycle of cash flow takes an impact. And in such cases, banks are not willing to freely lend, as they have moved to safer havens of highly rated, bigger NBFCs and HFCs. There's also a capping requirement in terms of the exposure they can have towards this industry. So that has hit the availability of funds for borrowing for small and medium-sized companies to a greater extent. And I believe till the time there is a relook in terms of capping, in terms of availability of funds for long term through the mainstay banking industry, liquidity will continue to be a challenge. It will be available for people who have a medium or a large size of balance sheet, who have a good rating. For them, it continues to be easy availability, too much money chasing them. For people who are building businesses, building their books, are on the path of getting upgraded in the rating cycle, the journey will continue to be tough. Yes, Sandeep.
Thanks a lot, Ashok. I think you made a very relevant point that we have created a buffer of liquidity, most of the institutions during pandemic time. And of course, the requirement of long-term debt side liability structure that is required for housing finance. And there are 2 points that comes up from your deliberation. One is, do we have really a structure where we need to create this kind of liquidity? I mean, ultimately, it's a loss. You create a one year liquidity and sit on that just because pandemic is there. It's something. It tells about the structure. That do we have really right structure? And secondly, even on housing finance side, I have been into that side as well. And we realized that 15-year, 20-year, I mean, people are talking about 30-year loan. And that's very relevant as far as housing finance and housing finance side is concerned. So those kind of instruments definitely are missing, one. And not only instruments, but even if you come out with the instrument, the participants in those instruments, that is very, very important. Can a pension fund come in? In housing finance, like NHB is there, SABI has rightly mentioned, can it be done through SIDB when it comes to NBFC? Maybe on a very, very micro and retail side, because today again the direction of credit flow is something on more consumer side. So maybe Thiru and Ashok, maybe Ashok, your view on liquidity and instruments that you think are relevant.
Thank you so much. I think most points are covered, and Mr. Nath has mentioned some points, and Sabyasachi has mentioned more onto the issues being faced by the small size, mid size companies. So while I will say liquidity has an issue from two aspects. One, which started somewhere in 2018 when ILFS happened. So suddenly everybody's focus moved on ALM. So anybody who was doing, let us say, secured loan tenure of say 5 to 10, 15 years, they had a challenge in terms of getting more liquidity by way of debt for long term, because every lender, whether bank or larger NBFC, started focusing more on short-term loans. So everybody was, in our experience, everybody was saying, okay, take a loan for 12 months or 24 months. Whereas our in MSME portfolio, we do small ticket MSME loans, whether secured or unsecured. Our tenure was, let us say, between 5 to 7 years for secured loans. So it was not making sense to borrow for say 2 years and lend for 5 to 7 years. Secondly, as happened in the last year with the pandemic first wave, so obviously the two major aspects of people from where NBFCs can generate liquidity was either you raise equity or debt. Both the sides actually become very conservative at that point of time, and they felt that okay, let us wait for some time, and even after when moratorium was over, they felt that okay, we should wait for another 3-4 months time. So our experience has been that by the time Feb or March this year, we felt okay, now things are okay, and we are kind of moving towards again on the growth side in terms of doing more business. And like many other NBFCs, we also raised our own equity in the month of March and felt okay, from April onwards things will be better. But this second wave has definitely hit very badly in terms of liquidity. So again, both the sets, whether they are lenders, banks, or even investors, they are again in wait and watch mode. So this is really creating the liquidity crunch for most, I would say, small or mid-size NBFCs. Now, on the other side, whatever has been done by the regulators, by RBI in terms of providing the liquidity, like Mr. Rath said, that it has been very, very limited to very selective NBFC companies which are highly rated. So even if you look at those maybe 100, 200 companies out of total 10,000 NBFC companies in India, so it has not really gone down. And banks has been very, very conservative. I think it is really important that when RBI comes out with the structure or products or instruments to provide liquidity to small companies, or they specifically mention that it is for let's say low rated or unrated companies, but nobody was willing to provide liquidity to those smaller or mid-sized NBFC companies. I guess either CDB or maybe banks have to be really given clear instructions by the regulators that where they have to look at companies which may be below the investment grade rating, or maybe unrated companies where looking at their leverage ratio. So some of the NBFC companies were ready to provide liquidity to smaller NBFC companies where they had a low leverage ratio. So similarly, if banks could provide the same kind of liquidity, it would have been better. So I guess there is need for everyone to look at those NBFC companies which are let's say in all kind of segments, and mostly for all these companies the portfolio is definitely priority sector lending portfolio which qualifies, whether they are into MSME segments or whether they are into solar or whether they are into education. So most of these NBFC companies are into building the portfolio which qualifies to be a priority sector lending portfolio. But I think regulators need to really look at them very, very specifically and separately with clear guidelines to provide liquidity to these companies.
Thanks, Ashok.
I will just add to Sandeep, please.
Sure.
No, I think as you rightly said, like we are in a, small sized NBFC category. this kind of liquidity crisis in the last 10 years of our operations, what we have seen is these kind of events like starting from 2015-16 demonetization to GST implementation to ILNFS DHFL crisis, and then come this big COVID pandemic. So what we have seen is like during, I mean, whenever these kind of events comes, and then there is a kind of liquidity crunch in the market. I think the intention of the Reserve Bank of India or the government is actually, the intention is a good intention with which the different schemes have been introduced, whether it is a PSL classification or a SPV classification or a this TRO thing. Everything actually, it's actually the intention is good, but then execution is becoming a kind of a little bit of an issue for us to get those kind of funds, because there is no relaxation in the eligibility conditions. That's the big thing. As everybody mentioned, and I totally accept that it is more towards the larger institutions rather than the smaller and mid-sized NBFCs like us. Particularly, we are doing a collateral free loans. That is one more thing. I mean, everybody cannot be seen in the same lens. So that is one thing what we have to, because they are not, I mean, they're not factoring the COVID factor. The risk matrix which is adapted is it's same for all the eligible institutions. I mean, result of which the liquidity availability for below A rated companies remains a big constraint for us, because we were bouncing back rapidly after the first year in the Jan, Feb, March of this year. Actually, we were bouncing back rapidly before this COVID-2 came. Uh, the support from the larger NBFCs to us, and also support from the foreign players, foreign investors, is very good compared to the domestic banks and PSUs, that because of the different kind of risk assessment. So because they all wanted to lend to the high rated NBFCs. So even the PSL classification, which is extended up to September 21, I think it's but I mean, our suggestion is that it should actually be extended more than that. That is one thing. And definitely the schemes in our view have been helpful for the way it has been created for, but there are the eligibility conditions. For example, even in the special purpose vehicle, it is the tenure provided is only for 3 months. So if the 3 months tenure is really very small for us, because if it is not for a year, then managing of ALM will be difficult, because the tenure of our loans to the customers are different. So we would like to definitely to ease the this kind of situation is, I mean, definitely, as somebody was mentioning, co-lending is one thing which we are trying with the banks and the NBFCs. In our experience in the last 4-5 years, we have been able to crack co-lending with 5 to 6 larger NBFCs, including with UGRO. Sachin is there here. So, but we are trying with the banks, larger banks, even after the guidelines for co-lending is being given by the RBI, we are not able to crack even one, because there are so much of compliance issues or so much of credit related technical everything is kind of, so that is another thing. So when we are not able to, even though the well-intentioned schemes are introduced during all of this crisis, because the crisis might happen again I mean, we are thinking like every business plan should include some kind of external impact once in 3 years or 4 years. That's a kind of society we live in. So how do we these measures or schemes which comes into picture, how do we execute it, or a little bit tweak those eligibility conditions so that it reaches the small and mid-sized NBFCs, which are very critical, because we deal with unsecured loans, and we are dealing with the so kind of a bottom of the pyramid customers. So that's the kind of viewpoint from our perspective.
Thanks, Thiru. The point that is coming up in our panel discussion is TLTRO limited use, limited NBFCs benefiting out of that. Secondly, even PSL guidelines. I mean, there is another point on PSL guidelines as far as NBFC is concerned. One is time, of course, but over and above that, in any case, most of the banks, they have already breached or reached the limits that they have set internally for NBFCs. Rightly so. I mean, nothing wrong in that. There has to be sector-wise limits. But anyways, they have reached. So even if you classify that as PSL, it doesn't make any difference because they're already there. Thirdly, on joint lending, Thiru, you I think mentioned very rightly, nationalized banks are not very active. Maybe they have their own risk assessment methodologies. NBFCs are more free to do that. But at the same time, do we really think that this 2080 that we are doing with banks is that right structure, or even for smaller NBFCs or housing finance companies, can there be a different way of looking at your direct assignment? Because securitization is easier, but the moment you get into direct assignment, it's a whole lot of things are completely different, and the kind of diligence that happens, the kind of time it takes for smaller NBFCs, and the structure of that instrument. I've not seen direct assignment structure in anywhere else, if my knowledge goes right, anywhere else than India. I mean, why direct assignment would be different from securitization in terms of taxation? Can actually this be directly dealt with some finance bill? Lawyers are better placed to comment on that, so that it is equal to securitization and credit enhancement structure along with that. And there are practical issues in terms of state stamp duties and all that. So these are certain things which I think regulator need to look at. Now, this discussion also spans to uh, NBFC as a whole, and since we started with the structure, I think Sachin would be in a much better position to answer that, because at this point in time, if you see our banking structure, I mean, one is of course your banking credit versus GDP. I mean, today we are at 56%. And if this need to go to 100%, which most of the economies are of our size, in that case, the kind of growth NBFCs and banks would need, my sense suggests, I mean, this growth has to be 30% almost for next 10 years. Only then GDP will grow something like 10-12%. Maybe on that side, Sachin, if you can throw some light, because you have lots, your NBFC is very, very diversified, and I'm sure within few years it will be one of the top-rated NBFCs, and maybe larger than banks also. Do you think there can be some instruments that side for such kind of growth that one can actually look at?
Yeah, so Sandeep, as you know very well, we focus only on one segment of the market, which is MSME in India. Our aspiration is to take very small 1% market share. While that, when you convert that 1% market share, it becomes a very large amount, and then people look at with great amount of skepticism on that. But to achieve that 1% market share, obviously the asset engine and the liability engine we are trying to build on a very diversified basis. I would, and so I think so. You're right that lending institutions have to grow if we have to continue growing even at a 7% of their average GDP growth rate. Accelerating from there, you need massive amount of credit dissemination to happen. My personal view is that post-pandemic, you will see, whether it is war or whether it is pandemic, after any of such event, there is a massive V-shaped recovery which comes in next few years, and that could happen in India as well. But I would just like to remind this. I know most of the panelists have made this view, and we have to agree and recognize that term lending from large banks to NBFC would continue to remain very challenged, and because of the lack of trust factors. Because when a bank lends to a large NBFC, they have no control over end utilization of the money. They give money for a retail MSME lending, money get utilized for a builder loan or a corporate loan, and that's where the trust factor is not there, both at the regulator end and as well as the lender's end. In terms of the co-lending, I would like to say this: if you think and go back when Shriram Transport Finance started, right, and when they started doing second-hand truck finance, at that time they also experienced the same thing because there was not many lenders who were really able to understand what this thing. If you look at the evolution of microfinance industry, there were no lenders which were ready to lend to microfinance institutions, right? Same what you will see that over a period of next 2 years or so, my personal view is that banks will start adopting to the NBFC's credit model and will, come to a seamless way of providing liquidity. We have been working very hard. So today, two of the largest public sector lenders are our co-lending partner, SBI and Bank of Baroda. Bank of Baroda, we are live. Assets are throwing. It has taken us 1.5 years to do that. And obviously, I must say that from an intent perspective, the largest bank have very clear intent to do it, but there is obviously organizational and systematic problems. So that's why it has taken so much of time. I am very confident that if we prove it right, there will be a massive number of NBFCs which will come into that model. Obviously, that need front-end technology infrastructure. We have written to RBI that credit enhancement should be allowed in co-lending because that would facilitate and accelerate the credit dissemination. So I think so NBFCs at this point in time, probably from a liquidity point of view, it is going through a massive transformation. What is definitely needed is an NHB kind of an institution, which is semi-sovereign, either run and regulated by RBI or by the government, which is a backstop for liquidity. Because otherwise, when I'm building an asset side and I'm unsure, so this month our disbursement will ramp up 3 times than what it was in the March. But now I'm worried that, today we are sitting on cash, but I'm worried 6 months down the line whether I can maintain that level of growth or not, right? And that's never good or healthy to build a business. I need to know both sides of my spectrum, whether I will get money and whether I can get asset and can I manage the credit and quality control or not, right? So that's, I think, so is definitely needed. We have to lobby as much as possible. We have to go and tell this to the government and to the regulator to create a sovereign liquidity entity, which is a backstop for liquidity or provider of liquidity, as NHB is at some point in time. In parts, it happens sometimes SIDBI is being used, sometimes NABARD is being used, but you need a permanent solution for this.
Yeah, Sachin, one question that comes to my mind out of what you mentioned here on liquidity side and long term, is this a supply side problem or demand side problem? Because ultimately, as you rightly mentioned, both the engine has to run simultaneously. I mean, you have to create an asset, a right asset, and also create a right kind of liability mix. Are we into, a little off-track question, but do you think we are into a liquidity issue or supply side issue or demand side issue?
We are a liquidity side issue. And the liquidity driven by lack of trust factor.
Okay. And demand side, you think it's any view on that?
No, I think so. Demand side, if obviously, you don't have to look at what is happening today. You have to look at little longish. I don't think so. India credit demand in India would ever have a problem. You have to choose your segment and you have to build very rigorous process of how you do that. And if you are an NBFC and not a bank, then obviously you have to be deeply focused and specialized, right? Rather than doing everything, whatever is available in the plate. You can choose to be a focus like Shriram Transport Finance. You can be choose to be focused like Kinara, which does machine tool finance. You can be focused on doing education financing. You can choose whatever you want to, but there is no dearth of asset creation. It is only time it takes because physical infrastructure, OPEX, credit costs, so on and so forth. But there is no asset side problem per se.
Sure. So I leave this to Elets. Maybe we can. Asif? Asif is not there, it seems. Okay.
Yeah. Thank you.
Yeah.
Thank you. We would like to thank all our panelists for a very wonderful and insightful panel discussion on how regulators can help NBFCs in generating liquidity amid the pandemic. We would now like to provide all our panelists with a small token of our appreciation. I'd like to start with Mr. Ashok Mittal, Chief Executive Officer, PrestLoans.
Thank you
Aman,
very
I
much.
think,
Thanks a lot.
Aman, maybe before that we can conclude what all has been discussed. I mean, I thought we'll get
Sure.
into that before this.
Sure. So if one of you want to Go
So
ahead.
maybe I'll give that opportunity to Sabi, if you can, conclude, rating wise, instrument wise, and what do we think? I'll also pitch in, and maybe all others can pitch in
Sure.
and conclude that.
Sure, Sandeep, we will do that. But I think before that, if you can just have 2 minutes or one minute from each of the panelists, that what
Next.
is the ask they have from RBI. I think that would be a great thing to know. So it will be a good conclusion. So I'll actually request Umesh sir to start with, being the big daddy and being the largest NBFC in the country and with huge amount of experience, sir. We'd like to know in 1 to 2 points if what should be the ask from RBI at this point of time.
Yeah, thank you, Sabi. I'll take liberty of calling you Sabi here.
Yeah, sure. I am known in the market as Sabi only, sir.
Yeah. Now, as Shachindra rightly put it, one is a dedicated refinancing arm of RBI or maybe institution is a need of the hour, and that is something which need to be asked. The PSL cannot be a time bound. It has to be a long-term arrangement. It cannot be said it's up to September, up to April. It is only giving, bank will say that, okay, it's only for another 3 months. Let us see. See, that's the kind of attitude will be there. So it has to be a long term, and there should not be a limit of 5%. If there is bank wants to do 10% through NBFC, it should be allowed, because bank can focus on their expertise, NBFC can focus on their expertise. And the third one is the accounting part of it. Still, all NBFCs have moved into the India's accounting, and banks are not. Therefore, there is a gap in understanding the assignment activities. So there has to be a clarity from RBI. RBI has to give some kind of parity in accounting understanding, so that the securitization becomes, especially Mr. Sandeep was mentioning about online securitization without seasoning. Now there is 6 months seasoning is required. So this need to be done. So that will become a smooth. So RBI need to bring in this clarity so that the credit flow to the right sector and to the underbanked and underserved goes on smoothly, so that we can plan demand and supply clearly. Otherwise, we need to work for 3 months, wait for another 3 months. Like that situation will come. So I think these are the three asks I broadly have.
Right. Thank you, sir. Sachindranath, Mr. Sachindranath, if you can have just your ask 2, 3.
No, not really. I've spoken enough, but as I said that what RBI, my ask with regulators has always been that if you now have come to this final conclusion that NBFCs are important cog in the wheel, then please provide enough grease for that wheel to keep functioning. Don't do it wherein this this doesn't run this smoothly. That's my simple answer.
Thank you, sir. Mr. Alok Aggarwal, what will be your ask from the housing finance companies?
So my ask is very simple. See, presently there's a lot of liquidity in the system. The issue is not of the liquidity. The issue is it being deployed evenly across the large and the smaller NBFCs and HFCs. So while the big daddies of the game are able to easily attract financing, it's the small and medium, not so high-rated companies which are not there. So there should be a specific window for a size limit of, say, below 500, below 1,000 crores, and who are not AA rated. There has to be special window for them. That's all.
Yeah, thank you. What about Mr. Thiru?
Yeah, definitely. I mean, there are two main things which I would definitely like to specify here. One from an organization perspective and another from an MSME perspective. So for the organization, for the institution like us, for the NBFCs, timely distribution of whatever the schemes like UGRO or anything, with just to try to give more push to the banks, so that with some kind of committed deadline, and more importantly prioritizing the last mile NBFCs, so that because of what the MSMEs which are in liquidity crunch might get that kind of a support. So that kind of a little bit of a more monitoring kind of a thing. And the second thing, from an MSME perspective, to be very frank, from our experience, last time we got moratorium and then we got all this restructuring or some kinds of benefits for the MSMEs. So this time during the second COVID, even though it was comparatively bad, but we could have, RBI could have explored more different kind of measures. But still, they have done about the restructuring everything. But still, if there is anything else that could have supported directly the MSMEs, that would have been also been helpful. So that's my submission. Thank you.
Thank you. What about Mr. Ashok? So, yeah, Mr. Ashok.
I think, I'm quite clear on this that regulators, Reserve Bank of India, need to come out of this rating mindset, because everybody, especially the banks, focus a lot on rating, whereas every lender or investor, they do their internal due diligence. So ideally, the liquidity should be provided based on the quality of portfolio, quality of management, quality of what kind of product the NBFC is offering, because we have seen that highly rated companies sometimes have not been really met the expectation of the market. So it is important that they look at all other parameters as well. Whereas all the liquidity support being provided is highly concentrated on rating. So it benefit goes only to selective top, maybe few NBFCs. So I think the focus should be how RBI can provide liquidity to the second, third, fourth level of NBFC companies who are really contributing a lot to MSME sector as well as the private sector lending. So it should be very clear to the regulators that they need to provide support to this particular set of NBFCs so that they can grow and they can become bigger.
Yeah. Thank you, Mr. Ashok. Sandeep, you beat, then I'll summarize definitely.
Sure. Yeah, I think my view is obviously instruments are available. Issue is not about instruments, but structure of the instrument. When we say joint lending, when we are able to do joint lending with pari passu, why not direct assignment is the question. It's only a matter of timing of the loan that we assign. If that happens, in that case, structure might change. So that's one thing. If one can do securitization with same kind of pool, why not it is applicable in direct assignment also? And ultimately, the difference only is about in whose book it goes. But if NBFCs want any asset into their book, can that be actually be good enough and simplified enough or credit enhanced while having direct assignment on the book? So these are joint lending, as credit mentioned. Why not have credit enhancement on joint lending? That also is a good suggestion. Why it should be like 20% only when it comes to bank? Why not 10%? I mean, world at one point in time has gone as high as 99% also. I mean, we are talking about 2080. I mean, why can't it be 95? Why can't it be 90%? Thirdly, I think in larger NBFCs, my view is today, because many large NBFCs are even bigger than banks, can that be classified as non-deposit taking banks? I mean, that will change a whole worldview about NBFCs. If we say non-deposit taking bank, which also means that they have access to different kind of instruments and different kind of investors in those instruments. The instrument is one part, but investors also are important. As uh, Alok said, that 15-year loan is not available unless and until you have long-term investors and long-term instruments available. There's no. I mean, these are all.
बस ये ध्यान रखिएगा, बैंक वर्ड लगाते ही आरबीआई वो सारी चीजें जो बैंक पे अप्लाई होती है विदाउट द लिक्विडिटी बेनिफिट विल अप्लाई ऑन यू.
वो वैसे भी आपके ऊपर एप्लीकेबल होने वाला है, being such a large institution.
Yeah, thank you. Thanks, Sandeep. Yeah, I think before I summarize, I had 2 points, which is again related to liquidity. So ultimately, our liquidity is also based on our collection. So recently, RBI came up with the restructuring 1 and 2, and this is what we have actually found out in our experience. That again, they have a common approach there. They have just said that increase the moratorium or increase the tenor by 2 years. Actually, we found that being a lab finance company, we are almost where our asset is, residual asset maturity is around 7 to 8 years. A 2 years is not enough, because if you give him a 2 years extension, you'll actually find he's able to only service the interest. And as a finance company, I don't want to give a moratorium on the interest. So he says the restructuring of is no use to us. So this is something I think we have actually approached RBI. I'm a member of FICCI. Through FICCI, we have actually approached RBI that it should be extended from 2 to 5 years, not again on a common platform, depending what is the residual maturity of your loan. If your residual maturity of your loan is maybe 4 years, then yes, 2 years is fine. Or if it is for a housing finance company, residual maturity is 10 years, then you should look at 5 years. So that's something that again is liquidity for me. Third thing is that, of course, we are all facing trouble of collection. I still don't understand that why NBFCs are differentiated, where we are said that your surface is applicable beyond 20 lakh rupees. For both the banks and HFC, the surface is applicable for more than 1 lakh rupees. So why 20 lakh rupees for NBFCs? Why not 1 lakh rupees for us? What is the logic? I don't understand. So that means, again, it goes back to the same old theory what Sandeep said or what Shachindra sir said, that NBFC are very important clog in the entire wheel, but they are differentiated. So that's something which I think is also one of our asks. So these are the 2 points, and I also completely agree with Umesh sir that why are we getting into index when the banks are not getting into? In fact, average provisioning, if you see, has increased for NBFCs from anywhere between 50% to 76, 78 or 80%. So why index for us? So this again is a little bit of, I'll say, differential treatment. So this is something which I think is what we need to go back to RBI. But now summarizing, I think very broadly, I'll summarize that everybody is of the opinion that RBI needs to come up with approach, which is a differentiated approach, depending on the size, depending on the quality of portfolio, depending on how long the NBFC has spent, what is the type of funding they are doing. So the approach has to be different. It cannot be a cookie cutter approach. There definitely is a need like NHB. There is a need for something like a SIDB, which will give a refinance window. Like what Sandeep said is that we need to look at direct assignment as one of the instruments. This is one of the instruments he spoke of, but there has to be a lot of innovative instrument which RBI needs to look at, and which needs to also cater to the smaller ones like us. So it has to be a little bit of what I say, which RBI need to have a consultation or a consultative paper with each size of the NBFC and look at what kind of solution or instrument it should come up with. And yes, what is very critical is that how do you implement it? As Shachindra sir said, that trust is very important in this entire thing. And I think biggest issue of all these so many instruments which are there in the market and not percolating down the line is the trust issues. There is no simple answer. How do you improve the trust issues for banks? Yes, but RBI need to do something. Maybe there has to be a common platform where both the NBFCs, banks come together. So there are a separate platform. IBA bank has a separate platform. NBFC has a FICCI has a separate platform. Multiple platforms. So a common platform has to come, and where all of us need to sit and discuss on the trust issue, and we'll have to ensure that this is something which is addressed. This is how I'll conclude with the summary. Thank you, everyone. And thanks, Sandeep, for moderating. And thanks for giving me the last part of it.
No, it was wonderful. In fact, I knew you would do a great job there, being having a rating background.
Yeah, thank you.
Thank you. Thank you to all our
Over to you.
panelists. Thank you to all our panelists for a very insightful panel discussion, and those are some very relevant closing remarks from all of you. Now, we would like to give a small token of our appreciation to all our panelists, starting with Mr. Ashok Mittal, Chief Executive Officer, PrestLoans.
Thank you so much.
Mr. Umesh Revankar, Vice Chairman and Managing Director, Shriram Transport Finance Company Limited.
Thank you.
Thank you, sir. Mr. Sabyasachi Rath, Chief Executive Officer, Karvy Financial Services Limited. Thank you, sir.
Thank you. Thank you very much.
Mr. Shachindra Nath, Executive Chairman and Managing Director, UGRO Capital Limited. Thank you, sir.
Thank you.
Mr. Alok Aggarwal, Managing Director and Chief Executive Officer, National Trust Housing Finance Limited. Thank you, sir.
Thank you. Thank you.
Mr. Sandeep Wirkhare, Managing Director and Chief Executive Officer, Indian School Finance Company. Thank you, sir.
Thank you.
Mr. Thiru R, Chief Operating Officer, Kinara Capital. Thank you, sir.
Thank you. Thank you so much.
Thank you to all our panelists once again.
Thank you, everyone, and stay safe. Thank you.
Thanks, everyone.
Thanks a lot. Thanks, everyone.
Bye-bye.